The Bank of England cuts rates but warns future easing is likely to be gradual. Welcome to Market Insight, I'm Ramzan Karmali. Well, the Monetary Policy Committee voted 8-1 to cut interest rates to 4.75% from 5%. But it said that it saw higher inflation and economic growth after the new government's first budget. Sterling rose almost 0.5% against the dollar immediately after the announcement, and gilt prices fell but quickly reversed that drop. Well, to get more analysis on the Bank of England's decision, I'm joined by Ambrose Fawkes, UK Fund Manager at Artemis. Ambrose, thanks so much for joining us. Well, today's rate cut was pretty much in line with expectations, but future ones now look a little less certain. Are you expecting a pause in December, and how many cuts do you think we'll get now in 2025?
So I think you're right, definitely a pause in December. February still looks like it's live. I think the interesting thing really is the knock-on of the adjustments, to their own forecast for GDP and for inflation. And, GDP, as we've been long arguing as a firm, GDP growth actually should be stronger. We've just had an inflationary budget. So both GDP and inflation have been nudged up. We've seen that really already reflected in the bond prices. But we would expect a far more gradualist approach from here. They're not saying in any way that they're done. I think they are going to be much more sort of hesitant, waiting, pausing. It's interesting seeing Bailey finally coming a little bit more hawkish.
Now, you mentioned their inflation. We had another warning today from a big retailer, Sainsbury's. They reported results today, but they said that shoppers could face higher prices. Why is that?
Well, the frustrating thing, I think, for the retailers and for all employers is they just had a big budgetary tax from the employer's national insurance contribution. So if you're Sainsbury's, you've got an extra sort of £140 million bill that you can't offset from internal cost pressures. So in fact, you're now going to have to reflect that in just pricing on the actual products you're selling. We're going to see this from Tesco's, from Sainsbury's. It's going to be broadly reflected, and that's going to keep underpinning inflation. Not least also, there's the new living wage increases as well.
But not everyone will mind higher rates, though, will they? There are some stocks you're looking at more closely now as a result, aren't they?
Well, financial services will be the natural area that will continue to benefit here. A higher rate for longer is going to really help, particularly the banks, where they've got these hedging programs. And we watched the 5-year swap rate; it's just gone up to about 4.2%. That's really going to help continue to grow their earnings over the next few years, despite the rate cuts. And that's very different to many other sectors in the country. So we continue to like the UK banks, the domestics, but also the international ones, because not least things like Standard Chartered will benefit from a higher US rate cycle.
Now, a lot has been made about inflationary pressure, but the OBR themselves said that inflation will at most get to 2.5% next year. So is this caution justified, do you think?
I think that there are still inflationary seeds around in the economy. I mean, obviously, we'd love to see inflation get back to sort of the 2% sort of level. But, there are still sort of stickier parts of services. And I think one mustn't forget, the wage pressure, the new living wage, is actually, or national living wage, sorry, is still actually an upward revisionary, driver. And that drives the entire sort of, sort of bandings above that. So there is still plenty, I think, that needs to be sort of digested. But I think the critical thing is that, inflation interest rates sort of are more in a controlled level. I think, though, that going back to the world of zero interest rate policy that we had of, much of the last decade is something that would be unwise and unhealthy.
Now, noticeably, the Bank of England didn't refer to Donald Trump's election victory, but what impact do you think his policies could have on them?
It looks like this will be very inflationary. And, they're already running very strong, big budget deficits. And actually, it's remarkable that so little was made by either candidate about this, not least with US debt to GDP at 120%. This all feels to me like interest rates will be very sort of underpinned in America for some time. And that's obviously got FX consequences. And interestingly, one of the sort of the interesting points to sort of cover here as well is just that with Trump's potential for tariffs, we saw yesterday quite significant weakenings in the euro curves. And so there's a lot of FX moves going on here, which is going to be quite interesting, and it'll be very telling how the market digests this over the coming weeks and months.
Interesting stuff. Ambrose Fawkes from Artemis, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.